This stock just fell with 18%, which makes it one of the cheapest footwear companies at the moment, and the company is Crocs. Now, most of you guys may know Crocs for being a ridiculous shoe that was created in the early 2000s, but it is much more than that. Now, we're going to find out if Crocs is a buy or not after its huge decline in value, which we can do by first going over some valuation metrics and other important factors. Then, talking about what is going to make Crocs grow in the future, and lastly, use a discounted cash flow model to determine if Crocs is a buy or not. Starting off with the valuation metrics, Crocs has a PE ratio of 10, which is pretty cheap compared to the sector median PE, which is 26.52, and even compared to the S&P 500 normal PE ratio of 15, it makes Crocs look very nice. Next up is the price to free cash flow ratio, and Crocs has a price to free cash flow ratio of around 7, making it look very cheap compared to the sector median of 12.07, and even compared to the S&P 500 average price to free cash flow ratio of 15, it makes Crocs look very attractive at the current price. Now, if we look at another very important factor, which is share buybacks, the company have bought back 14.71% of its shares in the last 5 years, which is really good, as it brings more value to the shareholders. But it's just important that the company do this at a reasonable price, which means they buy back shares when the stock is cheap. And to find out if a company has bought back historically cheap shares, I've made a comparison of the price compared to when they bought back shares on Seeking Alpha. And as we can see right here, it looks like they have bought back at both highs and lows, and not at any specific discount. But we do also have to take into consideration that the company is cheap according to PE and price to free cash flow ratio, which kind of makes up for these random share buybacks. If you want to find out this data, you can use, as I said, seekingalpha.com. And this is not sponsored, but I just really like to use their website. And if you want to find out this data, you can just go up to this tab right here, search in Crocs, then go to the charting option right here, press on that, and then select metrics and search price return and also total common shares outstanding. And that way you can compare the price return to the total shares outstanding and see if the company is buying back shares at the right time. Another metric that is very important to look at is the return on investment capital. And for Crocs, this number sits at an impressive 20% as the 10-year average. Now, the current return on investment capital for Crocs is around 21.79%, and compare that to the sector median average, which is 12.5%, it makes Crocs look very cheap. And it also shows that Crocs management is great at allocating capital. What about the profit margin? As this is another way to look at if the management is great at allocating capital. And here Crocs also shines, as they have a growing profit margin of 20.5%. And compare that to the sector median average, which is 6.8%, it shows that Crocs management is looking better and better. Lastly, moving over to the debt, Crocs has a decent amount, as it would take them 1.89 years to pay back its debt with free cash flow. So a debt to free cash flow ratio of 1.89, which is decent, and it just shows that the company has a average amount of debt, which is alright, as they have just recently in 2022 acquired a new company where they have taken a lot of debt on them, but it is looking better now. Now, moving over to what can make Crocs grow in the future. Well, one of the reasons Crocs might grow in the future is because of their skill to innovate products. As we have seen lately with Crocs expanding its product lines beyond its classic clogs, introducing sandals, boots, and collaborating with popular brands, designers, and celebrities. Another reason for Crocs growing in the future is expanding into international markets, particularly in Asia, where demand for casual and comfortable footwear is rising. This global push helps the brand reduce its reliance on US sales and capture growth in emerging markets where disposable income and demand for global brands are growing. But I do also want to argue that the company have been operating in Asia for a while now, and it just starts to grow rapidly for Crocs in 2023. Something that Crocs also have been focusing on is e-commerce, and if you look at the growth, it has paid off, as they have seen significant growth within this segment, but it has also been affected positively by COVID. So that's something that we have to keep in mind. Lastly, what can make Crocs an even bigger discount is if the management allocates the capital well, utilizing the free cash flow and taking advantage of the low debt to reinvest in growth initiatives, acquire complementary brands, or return value to shareholders, consistent buybacks, and high return on investment capital. But what I want them to focus on is the share buybacks, as if they can buy back shares when the company is relatively cheap, then in my opinion, it makes Crocs look very attractive at the current price. When it comes to evaluating Crocs, I used a discounted cash flow model and giving all the reasons mentioned previous, also taking into consideration that the sector median growth projection over the next 10 years is 4.5%, I estimated the future cash flow growth to be around 7.5% with a WACC of 13% and a perpetual rate of 2.5%. It leaves us with an intrinsic value of $155. But we also have to add some margin of safety, as there is some risk with Crocs, especially when it comes to their Hey Dude acquisition that they acquired in early 2022, which I will get back to. And this margin of safety I chose to put at 25%, leaving us with a final share price of $115. And comparing this to the current share price of $107, Crocs looks relatively cheap if all these assumptions are correct. Now we can also take a quick look at the spreadsheet. As we can see, we have the discounted cash flow model. And first of all, I looked at the average growth rate historically. And for Crocs, this is around 126%. But we also have to take into account that Crocs was pretty small in 2014, and they just started growing from there. And now the growth, it has been continuing on that big growth trend, but I do think it is going to slow down over the next 10 years. So, as we can see, I pretty much made the growth rate of around 7.5%, which, in my opinion, is a bit conservative, given that Crocs is looking pretty cheap. Then we have the perpetual rate of 2.5% and a discount rate of 13%. Then I discounted all the future cash flows and I calculated the terminal value and also the sum of the free cash flows. I plus that with cash and cash equivalents, as when there is cash in a business, we also have to take that into account. I minused all the debt, and we got the equity value. I then divided the equity value with the shares outstanding, giving us our intrinsic value. But of course, we had to add in a margin of safety, which was 25%. If we then use our margin of safety of 25%, it leaves us with a final share price of $115. And at the moment, the current share price is $106, which makes Crocs look pretty cheap if all these assumptions occur. Now, I just want to talk a little about Hey Dude, as it is the reason why Crocs just fell 18%, because the company did see weakness in sales, overshadowing the overall performance of Crocs. But the long term growth could be promising if Crocs' strategic plans do succeed on growing Hey Dude further in the future. And this strategy basically focuses on the profitability and market presence, and the strategy includes opening 30 new outlet stores in 2024, expanding into international markets, and refining distribution strategies, while also focusing on e commerce. Now, I do think this sudden drop in value is an overreaction, especially because Crocs did actually perform decently in the quarterly report, but I'm happy it did drop, as the company now looks relatively cheap. Thank you so much for watching, but if you want to learn more about stocks which might be at a discount, check out this video right here.